With 2018 well underway, you might be wondering just how the new tax laws affect your finances and, of course, how you can make the most of them to benefit your personal situation. Luckily, here with some tips is President and CEO of Premier Retirement and Wealth Management, Jeff Vogan. Jeff, thanks for joining us again.
Glad to be here. Thank you for having me.
Nice to see you. So, of course, like I said, we're getting more clarity on what these new tax rules mean and what they're going to do for people's finances. Can you sort of run us through some of the basics so people understand it maybe a little better?
Well, the first basic is a penny saved is a penny earned, or a dollar saved is a dollar earned. So a tax dollar you don't have to send to Washington or to your state is a good thing. The biggest one of the big changes is obviously affects corporations, and the corporate tax law actually got lowered by about 40%, not 40%, but from the high 30s to 20 or 22. It's going to be permanent, which means corporations can plan ahead. They can probably create better job security, put more back into the company, back in employees. We've already heard that companies are planning on doing company expansions, paying their workers more. So that's all good. It's great for the economy. But on a personal level, there are things that will affect us all personally, and those changes only are for 8 years. Mm-hmm. So it is a sunset, a law will sunset, which means it will go back the way it was. And so there's kind of a window of opportunity where this new tax law will create some opportunities for people to do better tax planning.
Right. So what are the real life implications of people who are investors or who are planning for their retirement? What's this new tax law going to do for them?
Okay. Well, to summarize the basics of individual tax rate, most everybody's tax rate will go down a few percent, which means almost every worker will probably save a few $1,000s a year. That might not sound like a lot, but if you add that up over time, mm-hmm. or if you consider you can use, well, I'll talk about strategies in a minute, but that does add up. The other thing is the standard deduction. For many people that didn't have enough write-offs to use the standard, or to even exceed the standard deduction, which usually used to be about $12,000 for a couple, is now $24,000 for a couple, which means that first $24,000 of what would have been taxable income is now exempt from income because it's deducted. So that creates a little more tax savings just from the deduction side, and I think those are probably the basics. Is everybody's going to save a little bit? Probably. One more thing that they did was lower the amount of tax savings or deduction you can get from home mortgage. Mm-hmm. It used to be that you could deduct up to a $1 million mortgage. Now you can only deduct up to a $750,000 mortgage, and you can no longer deduct interest on a home equity line of credit. Now, the good news is the old rules are grandfathered in on the mortgage limits of $1 million, but if you buy a new house and you decide, for people that can afford expensive homes, they don't get that extra $250,000 of mortgage interest that they get to write off. So
got it. Real life changes for people. And
sure.
You yourself, as someone who's a financial expert, financial advisor, how do your strategies change to sort of fit these new tax rules?
Okay, good question. The main thing is now we have a few extra $1,000s a year that we can spend. Now, economically, economists would say, great, that money will be spent on the economy and things will go better. Keep in mind that also gives people an opportunity to either save more, put it away for retirement, or pay down debt, which means which will also help accumulate more for retirement. And another strategy is to contribute more to Roth accounts. Most people may not know that their 401k at work may have a Roth option. Roth meaning you have to pay taxes now, but you don't have to pay taxes when you retire and take it out. If you use that extra, let's say $2,500 in tax savings you're going to get this year, and you're used to putting $10,000 away for retirement, now you can put that $10,000 away, and instead of getting a deduction, you have enough money to pay the taxes on that $10,000 right now at a lower tax bracket, so that later, when you have to take it out when you're retired, you don't have to pay any taxes on it. And it might be a big difference if you look at the long-term scheme of things there.
Got it. And if people, if they watch the news, they watch the media, they often might get the impression that it's really only the wealthy that are going to benefit from these new tax laws. But that's really not the case at all, is it? I mean, it's really across the spectrum of incomes that people are going to benefit, right?
Well, right. And what I just described is probably more likely a middle class or what the normal person, working class citizen can do. So I'll flip that on you if you don't mind. Sure. Is let's talk about one that maybe a wealthy person might be able to use. Considering a person that has done very well, put away a lot of money for retirement, may have, let's just say millions or $1 million or more dollars in an IRA account or a 401k because they had company stock that did real well or they saved real well. That's going to cause them a big tax burden once they retire and turn 70 and a half, when the government actually forces you to take that money out and pay taxes, you may be in a higher tax bracket down the road. So what a wealthy person might want to do is take advantage of the lower tax rate now, convert some of that IRA or 401k money. Let's say if they're close to retirement, maybe they have already retired, start pulling more money out than they need to spend from the IRA now, either convert it to a Roth or reinvest it, pay taxes now. Preferably, I think converting to a Roth makes probably more sense if you're looking at a long-term tax plan, because when taxes go up later, they don't have to pay as much taxes, first of all. They don't have to pay any taxes on the Roth, and then they won't have to pay as much in taxes on what's left in the IRA later. So again, a quick and easy tax strategy for those who are a little better off.
Right, and that's just one of the strategies that people can learn, for example, from your tax strategies for retirement. If they want to get this from you, all they have to do is go to the website, and of course you offer these great classes, and you of course have a great team that is willing and ready and able to assist anybody with planning for their future, making sure that they have enough money to make all their dreams come true. So I'm going to let them know how they can get information about the classes, and as always, Jeff, thank you for joining us.
Appreciate being here. Thank you.
Absolutely. Now attend one of the next Passport to Retirement courses hosted by Jeff at Pima Community College's Northwest campus. Dates are there listed on your screen. And for more information, to schedule a consultation or to sign up for the Perspectives newsletter or weekly market update or that tax handbook like we were saying, visit premret.com or call 520-780-9059. Stay right where you are. We'll be right back.